Hello, everyone. This is Elizabeth Rose, and I am bringing to you the 2022 housing market forecast. And of course, we are off to the races already this year. It's been wild and crazy. So just a little bit about myself. I have been a student of the financial markets for a couple of decades now, and I'm always fascinated by what's going on with housing, with interest rates, and with all of our secondary markets. I'm a little bit of a data geek or nerd, so I'm going to try not to get too deep in the weeds with that, but I do want to share with you some very insightful information that will help you get your arms around what we just came off of in 2021 and where 2022 is headed. So let's get started. So first of all, just to recap, in 2021, the forecast for housing was that we would have strong demand, the supply would be tight, and that tight supply would push home prices up by about a single-digit percentage. I believe they were bouncing around 7 and 8%. Well, actually, the forecasts were much lower than that, but then they started thinking 7 to 8%. The reality, though, as you well know, is that there was strong demand and incredibly tight supply. The COVID issues started causing supply chain issues, disruptions, couldn't get people to go to work. You know, they were collecting those checks that the government was handing out. And this pushed real estate values even higher than expected. And then on the interest rate front, the forecast was that rates would begin to rise just a little bit at the beginning of the year, and then they would recover as we moved into the fall season. The reality was that they sharply rose in March of last year. And then they sort of flattened out. And then finally they started to taper off and ease back probably around April to late April to early May. And then they kind of had what we would call in the industry a sideways pattern. Granted, daily they would be up or down. The overall trend was to somewhat move sideways. So that kind of recaps where we were with the interest rate standpoint, but let's look at some data. Housing stats for 2021. When we measure a lot of these, we're looking at what's called year over year. So it's like December of one year to December of the next year. And on this, on home price appreciation, it came in at 18.5% from December to December. So year over year. That's pretty robust. It's a lot higher than that 7 or 8%. Existing home sales, 6.12 million, up 8.5%. And, you know, if you stop and think about it, we've been talking a lot about how inventory is tight and it's multiple offer situations and homes are going to the highest bidder. You have to be prepared to pay over the price of the house. And that portends a perception that there's not enough, not only is there not enough houses out there, but not many sales because there's just not many houses, not much inventory. When in reality, we had a lot more sales than we have since 2006. So that's pretty robust. Median sales price, $377,700. We had an average sales price of $457,300. So this just helps explain right there why in December, when we got the announcement of the conforming limit being raised, it jumped a whopping $100,000. So our conforming home prices now, or home loan limits, are now $647,200. So quite a big difference in 1 year. Our inventory levels, well, we know they're super tight. 1.8 months supply of inventory. And to touch on that just a little bit further, while there's 1.8 months supply, it kind of makes you scratch your head, doesn't it? When people put their homes on the market on a Thursday or a Friday and it's sold on Sunday, it's like, how did we get 1.8 months supply because of that fast turnover? And I can't answer that question because that's measured by so many different entities. I'm not sure how they get that number unless it's through the contract phase, which we know most of those take about 30 days. So looking at that 18.5% number, when we look at the year over year 20 city composite. So what is 20 city composite? This is the S&P Case-Shiller report. They've identified 20 cities across the US that are major cities, and they use them in this composite to get a read on what's going on. Dallas-Fort Worth is one of those cities, and it's not two separate cities. It's Dallas-Fort Worth as one entity. So if you look at these major cities, we're talking about Atlanta, LA, New York, Chicago, Seattle. So you get the drift, all the major cities. We finished the year, or in November, it was 18.3. That was November to November. If you look at October, it was 18.5 from October to October. But what I find interesting is look at the ramp up. If you go back to December of 2020, where it was 10.2, and then we moved almost a full point, or a full point in most cases, sometimes a little bit more each month up to June. And then in July, we peaked and we're coming down a little bit, but this down escalator is much more gradual than this up escalator here. So that leads me into the next thing that I find interesting is what the forecast is for this year. So we're going to talk about that in a second, but let's look at the South. Sales prices in the South are outpacing the rest of the country. We do bring the US average to 15.8, but if you look at the Northeast, the Midwest, and the West, they're all 10 and below. So we in the South, and Texas is considered the South, we are doing double what everybody else is doing. So now let's look at those forecasts for 2022. We've got 7 of them here from Fannie, Freddie, CoreLogic, MBA, HPES, Zelman, and NAR. NAR comes in the lowest at 2.8%, and I'm not sure where they're seeing that. Fannie Mae's the strongest at 7.4. The average of all of them, 5.2. Now, if we think back to that chart a minute ago, where the year over year numbers are coming down, if they're not even coming down a full percent per month, and right now we're sitting at a lofty 18, then if they do come down a full percent per month, then it's going to be December before we hit 6. It would be November when we hit 7. So I'm thinking that we're going to have a little bit higher home price appreciation than any of these forecasts. But if I was going to bet on one of them, I'm going to bet on Fannie Mae at 7.4. Buyer traffic, still strong. You see Texas is in that dark blue. We're not the darkest blue that could be on the chart, but still very strong buyer traffic. And remember, this report is a trailing report. We're in February. We have not hit the home buying spring season yet. And that report was January, by the way, or for January. Existing home sales. Now, these are also lagging reports. So in February, we get January information. If you look at this from January of 2014 to today, you can see that we are selling a lot more homes today and have been since 2020. Now, this valley here was in March of 2020. That's when the world shut down. Everybody stayed at home. People didn't even know how to sell a house or how to list a house, trying to figure out all those dynamics. So the market kind of went flat. But if you notice, like ever since then, we climbed right back out of that really fast, and we are outpacing anything that we've done in the last 7 years. So while it's a tight inventory market, we still have robust sales. If you look at the new home sales in December, 811,000, 725 the month before, 649 the month before. They're keeping steady. We all know that they slowed down a little bit and had to tap the brakes just a little bit when those supply chain issues started happening. They had to get their arms around their pricing models and all sorts of things. Plus, they just had sluggish delivery of materials. And speaking of builders, their index dropped down to 82. Last month it was 83. And what this index measures is their confidence or their comfort level even in the market. Regionally speaking, the South is at 84, which is better than the rest. Well, the West, minus the West. The West is at 91. But what this does is it tells us what builders' confidence is in getting their materials, getting their laborers, putting out their product, and then getting it sold. Obviously, they don't having trouble getting it sold, but getting it built is still a challenge. So with that, you know, we look to builders to help boost the supply side, and we're in a very critical supply challenge. And if we wonder why, and we start looking at some historical information, we can get a picture of why. It still doesn't answer the full why, but we can at least answer it in terms of numbers. The US is short 5 million homes. That's a lot of houses. Production was going pretty smooth, pretty rampant up to about 2009, and then it really bottomed out. Prior to 2001, 2000 through 2007, which was a housing boom, production was even greater. But about 2001 through 07, during that boom, it sort of flatlined, and then 2008 happened, which was the beginning of the financial crisis, and in 2009 it just totally bottomed out for builders, because the financial crisis started in 2008. People thought it was going to be over by spring of 2009. That didn't happen, and then it started getting actually worse. And what happened is we saw lenders start tightening up on the builders. They didn't want to do anything speculative. They were nervous, so they started tightening credit lines and the ability for builders to access money to build houses. And quite frankly, builders were nervous too, because they didn't know if they could sell houses. So home production kind of fell off the cliff there. And since then it has come back, but it's only come back to about 50 or 60% of the production level that they used to do. I can't really answer the reason as to why builders are doing that, but they're trying to put out more inventory now. But in this market where you've got supply chain issues, it's just really tough to do, and they are still significantly lagging behind. We're seeing a backlog when we look at pending, permits. When we look at builder permits, we see the number of permits that have been issued, and then we compare it to the number of new starts. So when this construction actually gets started, and we're seeing that like 37% of those permits have not been started. So why is that? Well, it probably ties right back to that supply chain issue. So in order for us to get back to the inventory levels that we consider normal, which is a 6-month supply, we would need home builders to double down on their building, on their production. So if a home builder builds 50 homes a year, we need them to build 100. And we need that for every builder. Every builder would need to do that, and it would take 5 to 6 years to get back. So I say all that just to help you see that this environment that we're in right now, it's going to hang around for just a little while. We're not going to dig out tomorrow or next week or next month. So we need to be in a better position to help people. We need to be equipped. And so we're going to talk about some of that in just a minute. But before we get into that, let's talk about those first-time home buyers, the renters that are still renting, that maybe they haven't even thought about buying a home yet. When we look at the home appreciation, and it's like crazy out of control, we think it's on fire, 18%. Well, then we turn around, we look at rents and what's happening in the rental market. Apartment List puts out a report every single month, and in February their figures showed that the rent growth year over year, so that would mean January to January, February to February, 17.8%. Huge. So that's right there, same kind of figures as what we're seeing in home price appreciation. I think it's important for us to help renters understand this. Now, CoreLogic has some different figures. They say that for a detached single family home, those rents are up 12.1%, whereas a detached, whereas an attached, which is your townhomes, your condos, your apartments, those are up 9%. Even at 9%, you're not getting anything for your money on that. You know, there's no return. Another thing that I thought was very interesting is that where median price homes are more affordable than the average rent on a 3-bedroom property. So think about that. A home, a purchase home versus a 3-bedroom rental. It's more affordable in 58% of the counties nationwide, 58%. So another thing that we can help educate people on that are renting, that it's more affordable. Now, not in every county, but as a whole, it's more affordable to own a home than to rent. So, you know, when we got rising wages and rising inflation, if you can put a stopgap on that, on your rising housing costs, the only way to do that is through a home purchase. Now, I know people are saying that homes aren't affordable anymore. I've been hearing that. I'm going to assume that you have too. And the truth really is that they're just not quite as affordable as they used to be. They are still considered affordable. So every month, the home affordability index comes out, and the benchmark is 100. 100 is considered even or par. So if you're a golfer, you know that if you go to if you're on a hole and it says it's a par 4 and you have 4 strokes to get in the hole, and that's what you shoot, then you scored par. But if you are 1 over, then you bogeyed, and if you're 1 under, you've got what's that? I just went blank. It's not an eagle. Anyway, somebody will help me with that. But when we look at this, if you see the dotted line across the graphs there, that is 100. So that's par. So if everything is at par, then homes are affordable. They're not unaffordable. They're not too expensive. So they're falling like right in that sweet spot. If you're below the mark, then homes are not affordable. If you're above 100, homes are more affordable. So you notice the orange bars here. So from 2009, when everything went to hell in a handbasket, homes became more affordable. People were selling them. You know, they were definitely on sale, like a fire sale. That rolled over into 2016 and 17. So now we're out of that post meltdown era. Jobs are back. Everybody's back to work. The housing market stabilized. The country, our economic picture as a whole has stabilized. You can see home prices are still affordable. They did drop down in 2018, right just a tick above that line. And that's where we are today. So we are just barely over 100. Homes are still affordable. They're just not as affordable as they used to be. Now, as we move into the interest rate environment and the rising interest rates, that is most likely going to change. But for right now, that's where we stand. Back to the home appreciation thing. We had some forecasts. They surveyed 100 economists that deal in the housing market, the home price expectation survey. And they divided them into 2 categories, which is kind of interesting because I haven't seen this done before. But they had the optimist and then they had the pessimist. The optimists believe that by 2026, so between today and 2026, so 4 years from now, we will have gained 62.5% in home appreciation. I'll take that. I'm sure you would too. I'd even probably take what the pessimists are forecasting, 23.7%. And of course, the mid-range of that, the average is 43%. So as you can see, for those people that are fearful of being in a bubble, and they think the bubble is going to burst and home prices are going to decline, I don't see any experts that are expecting that. When we have an inventory shortage like we have, when we have population growth like we have, when we have new home formations, people coming of that sweet spot age that they begin to think about purchasing their first home, when those numbers are growing and we don't have the housing for those people, we're not going to see home prices decline. In fact, the other thing I see is people think, they hear the media and the media say that maybe home prices are slowing down. And I think what they think, I think the perception is that home prices are going to pull back. So that $400,000 house is going to drop to $395 and $390 and $385. That's not going to happen. The appreciation will slow, but it will not go negative. And you can see that by these forecasts here. And what's really cool, I just love this. This is based on that same survey. If you take a $350,000 home purchase today, and I know those are hard to find, but let's just say 350, because that's what they put on their chart here. 1 year from now, you're going to be at 372. Just a few more years from now, you're going to be up in the 400s, and you're going to finish out 5 years from now, $439,000. So that's $89,000 in home appreciation, which is quite significant. Remember, we're in Texas. This used to not happen here. So this is still a good time to buy a house if it's what the person is desiring to do and if they can qualify. Another great factor that I think is helpful when we talk to our home buyers, our future home buyers, especially those that are renting, is the difference in net worth. Now, the Federal Reserve measures this every single month, and they have for decades. They take a look at income levels and then renters versus homeowners. And if you go just to the middle of this graph, and we're going to take that mid-range, we know incomes in Texas are pretty strong, but let's just take that middle range of $46,000 to $74,000. A homeowner's net worth, as measured by the Federal Reserve, is $190,000. Remember, they own a home. By contrast, a renter's is $11,000 in net worth. That's $179,000 difference. So as you can see from this graph, owning does really pay, and you can build a lot of net worth in doing that. So going a little further into the forecast, so we've talked about home price appreciation. We do believe that home housing or home sales will remain strong in 2022. It's just going to pull back a little bit from 2021, and a part of that is going to be because of inventory, and it's also going to be because of interest rates climbing. But we do still see it being robust. We believe supply is going to increase. It's going to be marginal. It's not going to be like something super exciting to jump up and down about, but it's going to help. The labor supply, the supply chain, all of those things are going to factor into that. Also projected is rents will continue to rise. Increases are expected to remain above 5%. And as we just saw in one of the previous charts, they're anywhere from 9% up to 17%. So now the fun part, mortgage rates, the pain, they're going up. But we have to have perspective, right? Perspective is everything. Well, almost everything. Right now, and this is as of early February, rates had ticked up to 3.55%. This is as measured by Freddie Mac. Freddie Mac does a survey every week. We're now up at 3.8 or 3.9, I believe. That is with points. Their survey always shows like a half a point, 3/4 of a point, or a full point in their interest rate survey. So 3.55 at the beginning of February. If you look, if you can follow my cursor down in here, this is August, September, October, November, December. They pulled back a little bit during December, and then we got into 2022 and things started to really get ugly. So I'm going to show you what that looks like. So this is the bond chart. This is mortgage-backed securities, which I watch every day. And I took this picture back all the way to August. So we have 6 months here. And if you notice, starting over here on the left, we've got all of these lines. These are what we call candles. The green means the market opened and improved. Red means the market opened and got worse. And you can notice each day they're up and down, up and down, up and down, but relatively speaking, they're moving kind of sideways, right? In October, they took a little bit of dip, they hopped back up, then they took another little dip, and then they hopped back up, still kind of moving sideways. And then we hit middle of November and we took a little bit of a fall. It was painful, but then we went sideways again. Then we took another little fall. And then in December, all of December, somewhat sideways, meaning the rates are staying about the same. You know, you're looking at, let's say it was 3.25. So it's 3.25, 3 3/8, 3.25, 3 3/8, 3.25, 3 1/8. So it's just doing that little up and down, up and down, up and down. But then we hit January, and here's January. I'm not sure if you can see my mouse here, but here on January, we took the plunge. And then we took a really big plunge in one day. This was right after an inflation number came out that surprised everyone. Then the market tried to recover for a few days. That's each day, each of these represents a day. And then it just fell right back to where it was. And it tried to climb out of that hole again, and then it fell again. And now you see here, we fell off the cliff once again, and now we're trying to catch a bounce. So if you see this as a visual, and by the way, moving down, moving lower means interest rates are moving higher. So bad news, the market moves lower, or it's bad news is good for the market. But when you look at these, you know that the market got worse as it moves lower. So it's a little bit inverse, hard to explain. So I usually try to use words like improve and worsen instead of up and down, because when something's up, it actually means something else is down. So here we've got a worsened bond market, which means worse mortgage rates. Inflation, that is the archenemy of mortgage bonds. Therefore, it is the archenemy of interest rates. So if you turn on your TV and you see that inflation has moved higher, then you can just automatically guess that mortgage rates have moved higher. The Fed was saying initially last year, it's transitory, it's these supply chain issues. It's not transitory. They've been trying since 2009 to get inflation back to their level, their target level of 2 to 2.5%. They've been trying for year after year after year. They tried every little trick in the book, every little tool in their toolbox, and they couldn't make it happen. And then all of a sudden it happened. And now it's out of the bottle. So we have an expression in the financial markets about inflation, and we compare it to that genie in a bottle. And if you remember, like some of the cartoons, you know, if you let the genie out of the bottle, then it's hard to get the genie back in the bottle. That's how inflation is. Now that it's busted the lid and it's gotten out of control, out of the bottle, it's going to be really hard to get it reined in and back under control and back in the bottle. So the Fed's going to be using whatever measures they can to try to curtail that. The biggest one is hiking the Fed funds rate. So their plan is to hike rates starting in March. There's been all sorts of talk that they're going to have 7 hikes and 5 hikes and however many. Historically, they'll hike like 6 times. They used to do it like just one right after another, boom, 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 boom. The last couple of times that they've had a hike or a cut, they've actually waited a little bit in between Fed meetings to give the markets time to respond, so they knew how much more to cut or hike. Hopefully they will do that this time as well and give the markets a chance to respond. Now, the Fed hiking does not mean that interest rates on mortgages automatically go up. Interest rates for mortgages are tied to mortgage-backed securities. The Fed funds rate is what banks charge one another to borrow money overnight. So one night. But it still does impact all the other areas of finance. Now, here's another area that is going to be targeted. It already is, and this is why we're seeing the rates move higher. Since 2009, the Federal Reserve has been buying mortgage-backed securities, which I explained a few minutes ago, are what mortgage rates are tied to. As a buyer, they come in and they give confidence in the market. They tell that other person that's thinking about getting in the market, hey, if things get dicey and you need to pull out, I'm over here as a buyer, you're safe. So it really enabled our financial markets to continue moving smoothly. And we had very little disruption, and it kept rates low. By keeping rates low, they kept the housing market going, which kept the economy chugging along. Housing has been the backbone of our economy for a number of years and helped us stay strong. So one of the ways that the Fed's been helping is that buying, but they announced last year that they were going to start tapering. Now, what does that mean? Well, they had allocated X number of dollars every month to invest. They started reducing that. So in January, we were up to like 40 billion or 50 billion in investments. Well, in January, it dropped to 20 from 30, I believe. In February, they're dropping it to 10 billion. And in March, it's over. It's all over. Now, the other things they've been doing, so these are new purchases. The other thing they've been doing is repurchasing, rebuying their own bonds that were maturing. So as bonds came to maturity level, instead of just letting them go back out on the open market, the Federal Reserve said, we're going to buy them again. So they did. Well, now they're saying they're going to taper that. So January and February, they're going to buy back 60 billion of their bonds that are maturing. It's going to drop by 10 to 50 billion in March and drop another 10 in April and continue to taper off. When you hear in the media that the Federal Reserve is working to balance their balance sheet, they're rebalancing, this is what they're doing. They're stopping that spending. So it's going to put pressure on the mortgage market, and that pressure is going to lead to higher rates. Now, granted, if these rate hikes come in, they could potentially lower interest rates because if it lowers inflation. So their whole idea on the hike is to curtail inflation growth and bring it back down. If they bring it back down, we'll see interest rates retreat just a little bit. But then you've got that other piece of the puzzle of them stopping their purchases, which drives rates higher. So we may see more of just a little seesaw effect as this plays out. But we know that the tapering, the rate hikes, and then letting that balance sheet run off, meaning not reinvesting dollars, that's all going to play into where rates go this week, this month, this year. One thing with regards to the Fed is that their members do change. There's 12 Federal Reserve banks, 12 members, and they take turns at voting. So 6 vote and 6 are non-voting every year. They have 2-year terms. 3 of those terms mature every year. So you've got 3 leaving and 3 coming in. So that's always rotating. And that's so that you have a fairly balanced voting body of the Federal Reserve. Their main focus this year is going to be fighting that inflation. Like I said, it's out of the bottle. They've got a lot of work to do to try to get it to rein it in and get it under control. We know that they should have hiked sooner. I say we know. Many of us in the mortgage market believe that they should have hiked sooner. I thought, the first couple of months they were saying transitory. I was buying into it, but then it looked like it was so persistent. I was like, it's not transitory, but man, they want us to buy into that language. So where do we see rates? Well, this chart came out in January, and here we are middle of February, and we're already at 4%. So these numbers, and I'm not so sure they make a whole lot of sense right now. But you can see Freddie Mac, Fannie Mae, Mortgage Bankers Association, and the National Association of Realtors all have their numbers out there for each quarter of the year going into 2023. And it looks like, there towards the end of the year, we would approach the 4s. But like I said, we're at 4 right now. So it'll be interesting to see if these numbers change, if interest rates retreat a little bit once we hike in March. So I'm hopeful that we will see a slowdown of the increase in interest rates and quite possibly a little bit of a retreat. That would be nice. So we know home buyers have a lot of challenges right now. They, first of all, we know that they listen to the people at work and their parents and Zillow and the news. So they have a lot of challenges. They're hearing lots of information. Most of it is coming from sources that are not credible, or they're not reliable, or they just don't know. It's just opinion. So our job is to help educate them. And in order for us to keep this economy going, we have to do our part to help shed the light on what's really happening with housing, with home prices, with inventory, and so forth. And I think one of the things that we need to do, and I know I need to do this, is be real mindful of the words that I choose to use. And I really would like to figure out how to stay away from that phrase, inventory shortage. So what we know is that most homeowners don't even know where to start. They don't know what the steps are. They don't know who to trust. And they sure don't know whether or not buying makes sense. And that goes for renters and homeowners. There's many homeowners that might want to upsize or downsize, and they're wondering, like, I'm not sure that's smart. So it's our job to bring them tools and resources and knowledge and wisdom into the picture so they can make some good decisions. They don't know what their net worth is, their real estate net worth. They don't know whether they should tap into it, or if they can tap into it, or how to tap into it. They also don't know, like, if I'm sitting the fence because I think the market's going to fall. I think home prices are going to slow down. They're going to come back to where they were 6 months ago. Interest rates are going to get back into the 2s or the low 3s. If they're thinking those things, then they don't understand the cost of waiting, and they also don't understand what's going on in the market. So one of the things that we need to do is bring to them some solutions. Home buyer guides, when they're buying a home, selling a home, so forth, but bring them consistent education. And if you need some resources, I'd be happy to help you with that. But it's our job to be out there consistently sharing with them. The other thing too is with the housing, I don't want to use that word shortage, but with not having as many options out there. How about that? I still need, maybe you guys can help me come up with a good phrase. Collectively, surely we can find something. But another option is building your own home. And we now offer a one-time close program. Those went away with that financial crisis back in 2009. They're slowly coming back. And I'm so grateful that we rolled ours out last year so we can help with that. So they can go buy land, find a builder, build a house, and get everything financed in one transaction. But also just understanding, if they're sitting on the front porch, wringing their hands, waiting for things to get better, what is it truly going to cost them? And we can show them that with numbers. In this example here, it's $400,000 home today at a 4% interest rate. Now, granted, they might be able to get below 3, provided credit score and some other things going on. But just use 4 as a benchmark. Wait 6 months. That $400,000 house is now $420,000, and that interest rate is 4.25%. And you can see the cost going up. Just 6 months, a year, 2 years, and 3 years. If they have this information and they have some of the information that I've shared here earlier, then they can make an educated decision as opposed to trying to second guess everything. The other thing we can do is keep them in our sphere. We all know that, every day we're fighting the Zillows of the world, and I don't want to be Zillowed, and I don't think you do either. You put a lot of time and energy and effort into building each and every relationship that you have. So we need to keep them close at hand. So using something like HomeBot, where they can actually get the value of their home, and they can check and see how they're doing. It's kind of like a progress report card. And they can reach out to you for CMA, or even if they don't reach out to you, you can see that they're checking that. You can reach out to them. That's another way to keep them in your world, in your little echo world. Using an app, we have a rapid app that we can co-brand for realtors. It doesn't cost you anything, but that too keeps them tied to you, so they're not out using everybody else's website. They're not going to Zillow and Redfin and Open Door and everybody else that's out there working with iBuyers and iSellers. But I think overall, what we need to do is we need to be consistently in front of people, providing educational information and equipping them so that they can make good decisions and help them navigate the next couple of years. One other thing that I did want to point out, because I've been asked this question a lot, people think that demand is going to fall off. And so here's a little tidbit you can share with your home sellers and your home buyers. If they're waiting on the market to soften, and this is also another way to get away from the inventory conversation, but actually kind of plays back into the inventory conversation, but it's another useful piece of information, especially for people that are thinking about waiting. The balance of inventory should improve a little bit, but we've got more people coming into the market today. And this is something that will bust any of those fears of a housing bubble that's about to burst and it can't go any higher and that sort of thing. Started last year, for the next 3 years, there are more people that are coming of the magical age that has been identified as the point of entry into home ownership. That magical age is 33. They've been through college, they've had their fun playtime in their 20s, and they've traveled, and they've been all over and got their jobs, and now they're climbing the ladder and they're thinking about getting married, they're thinking about having babies. It's a magical age, and it's been tracked for decades and identified that 33 is the age where most people become a homeowner for the first time. Last year, this year, next year, and into 2025, there are more people turning 33, than any other time in history. So we've got more people that will be forming households between last year up through into 2025 than any other time in history. So demand will continue. Home prices will continue to rise. And so if people are worried that they're buying today and they're paying overpriced, they're paying for a house that they think is inflated, it's going to continue to go. And you saw the appreciation forecast earlier. So I hope all this information helps you equip your buyers and your sellers so they can make good decisions and get them to stick with you. And if there's anything I can do to help create some of that stickiness with any of these tools that I suggested, I'm certainly happy to bring you on board and give you your own co-branded piece so that you can help maintain those relationships and get more referrals from them, and continue to build your little ecosphere of clients and referral sources. So I hope this information is helpful. I know it was a lot and it was pretty fast, but I would look forward to any of your questions. Please send them back to me. And I'd just love to hear your feedback and all of your questions. So until next time, that is our forecast for 2022. And I hope you have a great day.